Generic AB H12025 review and valuation update. Generic has seen poor stock performance in 2025, as well as since the release of the initial episode on the company. I would not recommend re-listening to the episode due to the general poor quality, and I will recap the most important points in this episode. At the time of the initial episode, Generic traded at 61.5 SEK per share, at a market cap of 750 million Swedish kroners. Now, the share price is 50 Swedish kroners per share, at a market cap of 610 million. Taking into account the dividend, total return has been a negative return of 16%. So what happened? Actually, the company has delivered two stellar quarters, but the market sees some signs of worry, which I'm not in agreement with. In Q1, Generic delivered very strong earnings per share growth of 38%. However, the reason behind the strong growth was not revenue. Revenue only grew 6%. E-commerce and logistics are having some difficult times, leading to lower revenue growth. However, these are sectors where Generic has less pricing power and where the competitive landscape is fierce. Other sectors grew, like healthcare and SaaS, leading to stronger gross margin and EBIT margin. So the market sees weaker growth as a sign of things to come. Of course, over the long run, it's hard to increase earnings without growth. This is true, but it's important to understand different moving parts in Generic's business. They are increasingly moving away from highly competitive, some might call it commodity markets. These are services like SMS and mail, where Generic is a price taker, not a price maker. They are moving more and more into more specialized SaaS products, which are deeply embedded in the daily business of both private and public customers, and poses as an important security partner. We see this with the increased use of docs, which are steadily building a high margin, recurring software as a service revenue for Generic. Moving on to Q2, Generic continued with very soft top-line growth, only 2%. Again, this scares the market, leading some to believe that perhaps demand for Generic services are falling. But we must look at the sources of growth. Low-margin, commoditized services like SMS are being terminated. We can assume that these services materially affects top-line revenue, but contributes very little in terms of gross margin. Termination of such business is much welcome, in my opinion. The growth of the higher-margin SaaS products continued. Despite 2% revenue growth, gross profits grew 12%, which is more pleasant reading. The company scaled its OPEX in 2024, preparing for future growth. This leaves us with strong bottom-line earnings growth of 33%. For the entirety of H1 2025, Generic has increased earnings 36%. Meanwhile, the stock is down substantially. The market believes the growth to be unsustainable due to the lack of revenue growth. There's also a couple of other factors leaving the market concerned about the future. The long-time CEO left his post after Q1. He completely sold out of his position. In addition, one of the largest shareholders significantly reduced his position in the company. These are causes for some slight concern. However, I do not see the insider sales as a huge problem. A CEO leaving his post and selling out is completely normal, and especially so in Sweden. The large shareholder, which sold, still holds a significant stake and sold a third of his position. This large shareholder is closing in on retirement and could have plenty of reason to scale down his position. If there continues to be large insider sales, I would agree that there could be problems looming. At this point though, I do not see these factors as a negative for the long-term story in Generic. As a counterpoint to the insider sales, one insider with a significant stake in the company recently increased his position, albeit at a smaller scale. This alleviates some of the concerns. As a larger general point, I think that revenue growth is a bit overrated. The market often focuses on this, but I'm more interested in gross margin and returns on capital and underlying free cash flow and owner earnings. All the important financials are moving in the right direction. The company is moving away from low-margin commoditized products and into higher-margin recurring revenue with high switching costs and low competition. If you increase revenue not through volume but simply through pricing power, it can have extremely powerful scale effects. You don't need a lot of top-line growth if the source of the growth is capital efficient and scalable. Let me do a quick example. borrowed from the famous Chris Hone in an interview with the Norwegian oil fund. Take a company with a 20% profit margin. Actually, this is the exact profit margin of generic. The company with a 20% profit margin grows revenues only 1% above inflation. If inflation is 5%, a company with pricing power can grow 6%. Earnings growth, however, will be 10%. In this example, earnings grow 5% faster than inflation due to the pricing power. The example shows that even low revenue growth can lead to substantial earnings growth if the company has pricing power, scalability, and strong margins. This is why I'm not too bothered by low top-line growth for generic as long as I have confidence in the long-term story and growth of the company. Moving away from low-margin business into high-margin business is a welcome sign. Focus should be on gross margin and the bottom line, not top line. Now, this doesn't mean that I foresaw such low revenue growth leading into 2025. However, I own the company due to its scalability and the ability to grow earnings and free cash flow without the need to retain capital. I believe the valuation is compelling and gives promise of strong future returns for the shareholders. Generic had an initial valuation before Q1 at an EV/EBIT of 21.5. Now, after Q2, the company has an EV/EBIT of 15. The valuation is severely down, both due to the lower share price and the higher earnings. The free cash flow yield is close to 6%, meaning that double-digit growth in free cash flow will lead to a shareholder return above 16% per annum. This is highly attractive in my opinion. Despite concerns over top-line growth and some insider sales, I believe the risk-reward in generic has severely improved since the last episode. Full disclaimer, I recently increased my position in the company. This is not financial advice. Thanks for listening.